Hey investors, welcome to the channel. Today we're going to discuss how to increase your wealth faster using the metric return on equity, or ROE. I've been meaning to do this video for a while now. If it's your first time to the channel, I'm Dave Hathaway. We discuss real estate, investing, and building wealth. So in this video, you're going to learn how to use ROE, return on equity, to accelerate your wealth, to make sure you're being efficient and optimizing your capital, and also to just know when to sell a property. So instead of doing a whole video on this myself, I'm actually going to be reviewing a video that's already been done by Chris of BiggerPockets. He did a great video on this topic, although he was a little bit complex. So I'm going to simplify it down a bit, and I'm going to add some comments in there, stop the video, shorten it, and I'll leave a link in the description that you can watch his video if you want. But let's get into ROE and how it increases our wealth.
So like a lot of real estate investors out there, I bought my first rental property, and then the second year, I got a little bit more cash flow. The third year, I got more cash flow. The fourth year, I got more cash flow. I was like, this is awesome. I'm making more and more cash flow. And that's what the blue line on this graph represents. Your cash flow is going up every single year. But what you don't understand is that beneath the surface, your return on equity is actually going down every year. And that's the red line. So it actually starts out oftentimes in the high double digits, but the return on equity starts going down every single year. All right, you might be saying, Chris.
So right off the bat, Chris talks about cash flow and equity, which are super important to rental investors. Unfortunately, he doesn't really set up what equity is and how we should actually think of it. So equity is the amount of money that you would get if you sold the property. And so in the example that he's going to talk about, if you purchase a property for $100,000 and you put a $25,000 down payment, your equity in that property, if you sold that same property for $100,000, is your down payment, $25,000. Often as a rental investor, when we do a value add property, so you come in and you fix a property, we're buying it at a discount. So often there's equity in there right off the bat that's more than the down payment. And so whenever we talk about buying a property, right, we talk about purchasing a property for under what its actual value is. And so that concept is going to be very key when understanding return on equity, because often we only think about cash on cash return. And what I mean is we only think about, as an investor, we put $25,000 into this property. We always compute the returns off of that $25,000 instead of what we would actually have if we sold the property. So often when we sell the property, or if we have built up equity, we'll have a $25,000 down payment, but maybe if we sold the property, it's worth $25,000 more. So we could sell it for $125,000. And in that scenario, your equity is $50,000. So instead of computing what your cash on cash return is, I put $25,000. So this is what my return is. You should be computing it against, hey, if I sold this property, I'd actually make $50,000. So in essence, even though I don't see it today, we're computing the returns against the entire amount of equity in the property, which in this scenario is $50,000. Now he's going to give an example of what return on equity does with rental properties.
In the first year, you'll make about $1,200 in cash flow. Then $5,000 in appreciation, about $1,100 in debt paydown, and $640 in tax benefits or depreciation. Now, this is the numerator on the equation here. And let's say I put $25,000 down on this property. Great, well, that's my year one return. And as you can see on the screen, I'm making about 32% return on my money in that first year. As that appreciation and debt pay down pays you, where does that money go? It doesn't go in your bank account. It actually goes into the equity of the property. So I make $5,000 and $1,200 that first year. The next year, I don't have $25,000 invested in the property. I have close to $31,000 invested in the property through my equity in there. So keep that fractional math in mind. The equity is that denominator, or what we're dividing.
So he just gave a great explanation or example of what equity is or how you increase equity in your rental properties. And I want to introduce a term that I think will really make sense. So the reason that return on equity is super important is you have lazy equity. So he doesn't talk about lazy equity at all, and I'm sure there's a concept out there, but I think of it as lazy equity. You have appreciation and you have debt pay down, and that money is not making you any money, even though it's your money. It's like stuck in a forced savings account. And there's ways to access this lazy equity. He's going to go on and share those. But that's lazy equity, and I just want to make sure you understand that concept, that as your property appreciates and grows in value, and as you pay your debt down, so your mortgage gets smaller, you have this, what I like to call lazy equity. And that is just stuff that's not working for you at all. And this is what he's wanting you to pay attention to. And this is what's really important in the concept of investment properties. Now he's going to go on to share the numbers of what this looks like and why it is important and how it affects the return on equity. And so you're going to see it in graph form.
Dividing your investments by. Now, don't get overwhelmed by this table I'm about to show you on the screen, but it shows you this property and what happens in year 1, year 2, year 3. Look at that first column in cash flow. The cash flow is going up every single year. But now you can see that appreciation debt pay down from year 1 gets added to the equity in year 2. And then if you look at the far right here, what keeps happening? Your equity increases. And then that your return equity actually starts going down every single year. It goes from 32% to 27% to 24%. So I'm going to flip back to the graph I just showed you previously, because this graph is the visual representation of the table. Again, that blue line is a cash flow going up. That red line is return on equity going down. So the return on equity is going down. The growth rate of your property and your portfolio is slowing down as well. Well, what do? Well, this is...
And so after he just shared that graph, again, I want to go back to that lazy equity portion where you have equity that's building up in the property, that's growing, but you're not able to access it if you don't do a refinance, sell the property, do a 1031 exchange. If you don't do something, you can't actually access that property. It's just sitting there and doing nothing. So you're not able to leverage it. You're not able to use it. So it's a good thing, as in your values increasing in value, but we don't want money just sitting there doing nothing, similar to a savings account. We don't just want to put our money in a 0% interest savings account. And so in that graph, it shows that your cash flow is actually increasing because your equity is going up, but your return on equity, that metric that we talked about, that's super important to pay attention to, is going down over time because you have lazy equity. Now Chris is going to discuss how to use return on equity and optimize it to increase your wealth much faster.
You're going to buy a $100,000 property. You're putting down a 25% down payment. We're assuming a 6% interest rate and about $1,000 a month in rent. Now, I'm just using nice rounded numbers for model simplicity. And this was the same numbers I just showed you in the previous screens. So here's what it looks like if you buy that property and absolutely do nothing over 30 years. So from today, the property's worth $100,000. In 30 years, it's worth about $400,000. Congratulations, that asset has quadrupled in value. However, that also means your return equity is going very, very slow. Now, I'm adding a red line on the graph here to actually show you the equity in the property. You can see every single year that red line gets a little bit closer to the blue line, which is the property value. So your equity is building, which just goes back to that table I showed you a few seconds ago. Let's stop here for a second and talk about that investment to equity growth loop I was talking about, because we need to take the equity out and reinvest it. As a very loose rule of thumb in real estate, it's not uncommon to have your equity doubled in about 5 years between debt pay down, some market appreciation, and some value add you do to your property. So in this case, we put $25,000 down, and in year 5, we have about $50,000 in equity. So we're gonna take that equity and go from one door and go buy another door. And so that red on the graph represents the second door on there. And you can see the jump in property value. Why did it jump? Because we took the equity out and used it as a down payment and took out a new loan on another property. Where it gets so exciting is look at that year 30 mark. So that first property is about $400,000 in year 30. That second property, or with two properties, it's about $750,000. So again, concept here, equity out, go reinvest it. Now let's do that again at the year 10 mark in this portfolio. Year 10, our overall equity has doubled from about $50,000 to $100,000 now. Now we're taking out some of the equity and we're gonna go buy another property, another door, so we have another rental in our portfolio. And now you can see that yellow line, it jumps up in year 10 in total property value. Again, because we took the equity out and used it as a down payment on a new rental property. Now here's where it gets really exciting. Look at that year 30 mark. We were about $400,000 for one property, about $750,000 for two properties. Now with three properties, we're at over $1 million in property value. So hopefully you're starting to see the exponential growth of maximizing your return on equity. Now let's go through one more example.
So Chris does a great job in this example of showing you how it increases your wealth, but he doesn't really explain how you're tapping into that lazy equity that I talked about. And there, I assume that he's using, or he's talking about the BRRRR method, where you're purchasing a property, you're rehabbing it, you're renting it, you're refinancing it, and then you're repeating. But he's put an extra R. So every 5 years, he's saying you're going to take that equity out with most likely another refinance. Because when you refinance a property, you don't have to pay capital gains, but you can tap into that lazy equity that we talk about. And this graph that he's showing is showing you how powerful using leverage is, but also how powerful appreciation is and how powerful using a refinance to tap into that equity. So I think he does a great job overall in showing you how it increases your wealth a ton. Instead of just having one property, if you turn that into 3 or 4 or 5 properties. I also think that it's important to show you, hey, just with 3 properties in 30 years, that value of that portfolio is over $1 million, which is awesome. I think that often as investors, we get caught up in this concept that we have to have 10 or 15 or 50 or 100 properties. And that's just not the case. If you purchase good properties in good locations and you just let the market help you out, you do have to have some cash flows. You can't be losing money on your properties. But if you're purchasing right and you're purchasing in the right locations, the market is going to carry you up with more appreciation than average. So if you can do that, you're going to see your wealth increase a ton. So let's move on to the last clip.
A common question I get here right now is people say, Chris, this sounds great. I get the concept, but how do I know when do I stop reinvesting my equity and this the properties pay off to make more cash flow? That is a great question. And this is something that you need to reevaluate on a consistent basis as a real estate investor. But my simple rule of thumb is that if you were to stop acquiring properties today, do you have enough cash flow or enough cash flow once the properties are paid off? If you do, then hey, you may have the luxury to stop buying new properties. If you don't have that luxury or you need more cash flow, then guess what? You need to stay in growth mode. And what I do, and most real estate investors I know what they do, is they go out there and they reinvest their equity. Now, they're reinvesting their equity, they're still finding deals, they're still saving money, they're still doing all of their stuff. But if you need more cash flow, then you're in growth mode. You need more properties. Keep your portfolio growing. The next common question I get.
So I love what he talks about here. He's just talking about, and he doesn't actually allude to it, but knowing your monetary goals. Now, when you go into purchase properties, your goal shouldn't be like the famous Sandlot quote, forever, to just continue purchasing properties, refinancing them until you have 1 million properties, or just it shouldn't be an infinite cycle. There should be, hey, I'm going for this goal. And that goal can change in your future, but you should have some sort of monetary goal. Hey, I feel comfortable if I have $10,000 in cash flow coming in to stop if I wanted to give yourself that option. You should have some goal. He doesn't really talk about goal setting, but that is super important, that you're not just, hey, I have to do this forever for the rest of my life. The concepts that I think Chris misses in this video, or he doesn't share, and it's probably because he's just keeping it to real estate, is again, knowing your goals, knowing your financial goals, and knowing how much money that you're looking to create with real estate investing. And the other one is that you can use ROE to determine when to sell a property. So if you have a ton of equity tied up into a property and it's producing a super low ROE, then it may be time for you to either refinance or sell that property and tap into that money, because often you can get a much higher return. And that's what we're really looking for here, is to increase or snowball, compound our wealth by getting the best return possible. So if you're making 3% every year as your ROE, maybe it's time to sell that property and tap into that $200,000 that even if you put it into something else like a money market, you'd be making more money with less stress. So that leads me to the last thing that I think he misses here, is that there's options outside of real estate when you consider ROE. And when I'm thinking about what I'm going to do with my capital, or if I should sell a property, not only do I think of how much I think that property can appreciate more, if the rents can increase more, and if I don't think they can, the property can appreciate and rents can increase more, that's when I start thinking of, okay, maybe it's time to sell the property and take that equity and maybe put it in an index fund or a real estate syndication or a money market. And I just start evaluating where I can put my money and start thinking about different stresses involved, how much effort it's going to be for me to be involved. Maybe I'd be okay with putting that equity, maybe it's $100,000 of equity in a rental property, and instead of having all the stresses that come along with owning rental property, maybe I take that $100,000 and put it into a real estate syndication that's making on average 10% a year. And I have really no involvement. I'm a passive LP investor. So all I'm saying there is, when you're looking at return on equity, not only do you want to look at, hey, where does this property have to go in the future? Maybe it's capped out. Maybe it's time to sell it. Or maybe there's tons of room for it to run in the market. Maybe you think there's lots of rent increases coming. In that case, or in that scenario, if you have a lot of equity, it's much better to refinance the property, let those rents go up, let your property appreciate. So you just get that basically equity buildup instead of selling the property off. As in that first example where you think everything's capped out, now you want to actually access that lazy equity that we talked about. So guys, I hope that makes sense on return of equity, how you can use it to increase your wealth. If you find these videos valuable, I'd love you subscribe to the channel, hit the thumbs up. We'd love to help you along on your real estate investing journey, and I'll see you on the next episode.